Hello and a very warm welcome back to the channel. Today we're going to be taking a look at all the different investment types out there and how they stack up against precious metals. But before we do that, and normally I do want to keep interactions and comments to the weekend videos, which are more of an informal chat, but there's no way I could actually not mention something that happened over the weekend. I was out at a neighbour's house and I came back and I'm still actually quite in shock now. I can't believe it. But one of my all-time favourite YouTubers, 365 Days of Silver, has actually given me a shout out on his community page, and I just wanted to take this moment just to say how thankful and grateful I am, not only to you 365 Days of Silver, but also to all of your subscribers who have come across from your channel to give their support. And I have had loads of support, loads of comments. I've seen a real spike in subscribers since you put the post on, so a massive thank you to you 365, but not only you, to everybody who's come over and shown the channel a little bit of support. I genuinely cannot tell you just how much it means to me and how grateful I am to you all. So thank you so much. And other than that, I did have one comment I wanted to just quickly discuss, because I did ask for suggestions for these videos on last Friday's video, and I did receive a response from Every Cloud, who would like to see more tips and information on the good ways to hunt silver. It's a brilliant idea, Cloud, and something that I'm definitely wanting to do going forwards. But it's something I want to, I just want to put together. So I want to prepare that video a little bit more. So definitely look for that going forwards in the next couple of weeks, because I do fully intend to do another video going into a little bit more detail on hunting silver in places like antique stores, second-hand stores, charity stores, car boots, flea markets, that kind of thing. So that being said, I am looking to do the comments on the weekend, so I will be addressing any other comments that you've been kind enough to leave throughout the week on that episode. So please look out for that, and I hope to see you there soon. Now, very quickly before we go any further, I've had a delivery from the Royal Mint today. I'll just pass that under so you can see that. So I'm just going to very quickly tear this open, because I'm pretty sure this is this month's minimum of 1 silver Britannia. So I bought this just to make sure I do that, and then any other I'll leave the invoice in the box. Here we go. And and yeah, so any other silver will be additional to this, but this is my minimum monthly addition to the stack, as it were. Okay, and here we go. That's just another, we get to a bit of focus, there we go. That's just another Britannia, and actually my first standard Britannia. Again, as I mentioned in the previous episode, I have gone for Queen Elizabeth, as I do feel they'll carry more, maybe a bit more of a premium going forward, as there's not going to be many of them minted from now on. So hopefully that will turn into a good investment, and over time I may hopefully see a good return on that. Excellent. So we'll add that to the others there, and again, you know, the stack of standard Britannias has now commenced with that very first one. These are all silver Britannias, but as I say, they are part of the Myth and Legends range. So although they are technically the same coin, they're not standard coins. So there's a few. The pile is starting to add up now. Hopefully, it won't be too long until it's getting bigger and bigger. So anyway, with that being the case, let's get on with the video. Now, before I do go any further, I do want to say, and I know that a lot of people say this, but I am definitely not a financial advisor. Now, the reason everybody says that is we are talking about people's money here, and I will be giving you my personal opinion on a lot of things. Now, I don't want anyone going out and losing money. The whole purpose of the channel is for me to give some of the things I've been able to learn over the last few years, and pass that on to benefit other people. So please, definitely, everybody, do your own research when it comes to this kind of thing. And if you're ever putting money into anything, just make sure you know all the risks involved, all the pros and cons, and that you're securing what you're doing before you look to put any money into anything. Okay, so before we look at types of investments, I suppose the best thing to do is to ask, what exactly is an investment? In the most basic way possible, an investment is something that you obtain now at a cost, in the hope that you will be able to obtain a higher return on that item in the future. So that being the case, the most common type of investment, and certainly the one you've probably heard the most about, would be stocks and shares. Now, what a stock or a share is, it's when you purchase a small part of a company. Now, you could own shares in one individual company, or you could purchase shares from multiple companies. Now, there are two main different types of stocks and shares, which would be shares that provide a yield and shares that provide growth. Now, the difference between the two is a growth share is just your very standard run-of-the-mill share that you invest into a company. You believe that company's a great company, it provides a great service, and therefore it's going to grow over time, and as such the value of that company's shares will also grow over time. So that's a growth fund. Now, and as I said, to make that very in its most simplest form, that's something you would buy £100 worth of shares today, in the hope that in a year's time they would be worth £200. Now, the other kind of share that I mentioned, a yield share, is something that pays what's known as a dividend. Now, dividends can be paid annually, quarterly, or even monthly. And what a dividend is, it's a small payment that the company gives you as somewhat of a thank you for just owning the shares. You have to own the shares on a specific day of a month, which is known as the DivX date. Now, I won't go into the details of that in this episode. Now, if you want me to go into that in more detail in a future video, please let me know in the comments, and I'll be more than happy to do so. But basically, as I say, you get paid a small payment just for owning shares in that company. That money goes into your account as cash, and you're able to do whatever you want with that money. Now, I do own some yield shares and I do own some growth shares. However, what I really like is a company that offers something somewhere in the middle. A great company to use as an example would be Johnson & Johnson's. Now, Johnson & Johnson's have actually over time been able to accrue themselves the nickname of Old Reliable in the stocks and shares community, and the reason for that is they over time generally the share values increase over time, and they offer a very regular dividend payment. So every 3 months, every quarter, I receive money from Johnson & Johnson's just for owning the shares I have in that company. The kind of companies that you will find that offer a dividend payment or a yield are older companies that are fully set up. They don't really have to put a lot of money into growing the company any further. They're there, they know what they're doing, they've been doing it for years, and so they take a chunk of their profits and pay it to the shareholders. Now, the benefit of that for them is it's very tempting for shareholders, and they're more likely to buy shares in that company. Now, a company that is more young and more developing. Maybe it's a tech firm that's only been around a few years and it's trying to develop itself and offer new products. They're not so likely to offer you a dividend yield because they're more likely to reinvest that money back into their company to help grow the value of their stocks. So they want to increase your monetary value by making the stocks and shares you own worth more money. So the next thing I'd like to discuss very, very, very quickly on this one is what's known as a CFD. A CFD stands for contract for difference. Now, I'm not going to go into a lot of detail regarding contracts for difference, purely because they're not something I would ever recommend anybody looking into. It's very, very basically, it's when you're not only risking your own money, you're risking potentially thousands of pounds of somebody else's money. It's the type of investment that can lose you everything in a couple of seconds, and therefore it's just too much of a risk. It's something I would never do myself, and I would never ever recommend anybody else ever do. There's just too much risk involved. So again, I don't even want to give you much information about that because it's a great way for people to become bankrupt. Not only bankrupt, but find themselves in hundreds of thousands of pounds worth of debt in very short amounts of time. So that being the case, the next topic I would like to discuss further would be what's known as an ETF or a index fund. Now, ETF stands for an exchange traded fund. Now, these are basically the same thing. There is one slight difference to them, which I will come to in a moment. But basically, it's a fund that's managed by an actual financial advisor, and they pick different stocks and shares from loads of different companies, put them into one fund. So when you invest £1,000 into that fund, you could be buying 10 pence of Amazon, 10 pence of Apple, 15 pence of Tesla, or any, a multiple of different companies. And these are people who know a lot more about the subject than I do. They have a lot better information on where the money's put, or where to put that money. So it's very popular for people to invest through an index fund or an ETF. The most popular one I would say is, and certainly one that I invest in myself, is an ETF or an index tracker that tracks the S&P 500, which is basically the top 500 companies in America. It's a fund that has consistently beaten inflation year after year. It has an amazing record for doing so, and it is considered one of the safest investments out there. It's actually the investment that people like Charlie Munger, Warren Buffett and Peter Lynch advise new investors to start off investing their money into. If you don't know who those people are, they're three of the best investors on this planet, and certainly someone whose advice you should take a lot more than people like me. So I mentioned there was one slight difference between an ETF and a index fund. Now, that only difference is an ETF is something that could be bought throughout a trading day, like a stock or a share can be. So you could invest £1,000 any point or any amount of money, £100, whatever it is. A lot of these trading platforms will have a minimum investments of something like £10 or something. So there's, normally you can put really small amounts of money if that's all you can afford. But as I say, the difference is an ETF can be purchased at any time throughout the trading day, whereas an index fund can only be purchased at a close of day when the price for that day has been determined. If you are looking to invest money in an index fund, which is something that I personally do myself, one great way to do that is what's known as an stocks and shares ISA. Now, an ISA, of course, is an individual savings account, but a stocks and shares ISA it's basically just buying an ETF or buying an index fund in a separate account. The difference and the benefit to that is you can invest up to £20,000 per year completely tax-free. That's in the UK, of course. So that was one of my first go-to investments, which putting some money aside into an investment ISA. Investment ISA is just another term for a stocks and shares ISA. It's what I look as my long-term money that I plan to stay in that pot until I retire, and then look to reap the rewards of the investment at that time in life. So that's my foundation investment. So that's what I start off at, and then after that I look at other companies that I can buy stocks and shares, that kind of thing. So after index funds, ETFs, stocks and shares, etc., we come on to something that you will probably be a lot more appealing to most of the people watching this, and that's what's known as a commodity. Now, a commodity is very similar to a stock or a share, but it's when you're actually buying physical items. Now, that can be gold. It can be silver. It can be things like crude oil, anything like that. That's a commodity. It's traded in exactly the same way as a stock and a share. You can invest any amount of money you want. The definite benefit of investing through a commodity as opposed to something like this is, if I was to buy 1 ounce of silver, which is exactly what this is, as you can see there, this is 1 ounce of fine silver. If I was to buy that as a commodity, that would cost me around £17.50 for that ounce of silver. Now, I would never see that ounce of silver, but I would own it, and it would go up or down in value accordingly, and I could sell that at any point at the click of a button, and I would get the full value of that ounce of silver straight back immediately. Now, this here, which is an ounce of fine silver, cost me around £30. Now, the reason for that is there's a lot of craftsmanship that's gone into making this into a coin. It's a beautiful item. A lot of things have to happen for that to happen, and people need to make profit off of their work. So by the time you receive this from the Royal Mint, it's actually just over £30. I think it's about £33 at the moment, including VAT for a single ounce. So as you can see, if you were looking for purely just an investment, the best thing to do is possibly consider buying it as a commodity. You will certainly buy. It will certainly be the cheapest gold and silver you can buy in relation to spot price. You will not own that gold and silver. You won't ever be able to see it. You won't ever be able to touch it. It's a completely different kettle of fish, if you ask me. When we're talking about stacking, there's a hobby element to it as well as an investment element to it. This is something I hear 365 Days of Silver talk about a lot in his videos, and it's something that I completely entirely agree with. To be a stacker, you've got to see it partly, at least, as a hobby. You've got to enjoy purchasing these things. You've got to enjoy owning them. You've got to enjoy browsing for the different ones and looking at all the different mints and what's available out there. If you don't have that enjoyment, if this is literally just a lump of metal to you, you really might as well just buy it as a commodity through a trading platform. Okay, so next, what I'm going to discuss about is very, very similar to a commodity. It's what's known as a future, and futures basically are kind of commodities, but how a future works is, rather than just buying that commodity, sitting on it, leaving it and waiting till the market's right and then selling it, a future is when you actually buy an actual ounce of gold or an actual silver crate of Silver Britannias, however amount you pay into it, or you're buying actual drums of oil or actual crates of Coca-Cola. Now those things will have a sale date on them, so when you buy them at a certain price. They will be sold on a certain day at a certain price, and based on that price you can make a profit or a loss. So as I say, a future is a commodity, but it's a lot more stricter. It's not something I've got into much myself. If it is something that sounds of interest to you, then definitely do the research on that. There's a lot of videos available online that go into a lot further detail for all the topics I'm discussing today. As I say at the beginning of the video, this is more just a brief introduction, just in case people were interested and just wanted to get a little bit more information and knowledge about investment in general. Okay, so after futures, one of the last types of investment I'd like to discuss is something that's known as a REIT. That's REIT. And REITs are absolutely brilliant. What REIT stands for is a real estate investment trust. Okay, and what that is, it's basically a way to own property if you're not able to afford to buy a house. Because what you can do is you can invest £100 into, and what you're investing in is a large property conglomerate who owns God knows how many properties, but hundreds or thousands of properties, and you're just putting as much money as you can afford into their properties. So it's a conglomerate of properties that people like yourselves put money into, and based on the property market, that money will increase or decrease in value. So as I say, a REIT is an absolutely brilliant way for anybody who can't afford to actually go out and buy a brick and mortar house to actually be able to still be able to invest in property, because as we all know, property is an absolutely brilliant way to invest your money if you can afford it. Now, that's not to say it's guaranteed. There's literally no guaranteed investment, and anything can happen at any time that could devaluate your investments, and that's the risk we take as investors. But if you don't invest your money, it's just going to lose value as per inflation, which at the moment is rising at around 11%, and that kind of scares me a bit, to think 11% of the value of my money is going to disappear just for it sitting in my bank account every year. So I definitely feel that, investment is worth the risk as long as you do your research, you understand where your money is going, and you mitigate that risk as much as you are possibly able to do so. One thing I did want to mention at the beginning of the video, which I completely forgot, to be honest with you, is that 75% of all people who invest lose their money. And why is that? If investments sound so easy, put £1,000 on the S&P 500 and leave it 10 years and it'll be worth £5,000. Well, if it is that easy, why do 75% of people lose money? Well, a big chunk of that is as I said earlier, it's people who are trying to invest through CFDs, which is a very, very dangerous game to play. After that, which is kind of the same thing, but in a different way, is people overinvest. Now, you will need an amount of liquid cash for a number of reasons. It could be an emergency, it could be the gas bill's just a bit higher this month, and if you put all your money into precious metals, say I bought all these this month and emptied my bank account to do so, and all of a sudden my car breaks down and it needs to go into the garage, and I've got no other option but I've got to sell these again. And because of premiums, I am going to lose money off them straight away. Now, it doesn't matter what you invest in. Once you put money in an investment, the chances are that you lose money instantly. If it's in stocks and shares or anything traded on a trading platform, such as Trading 122, 121, or eToro, that kind of thing, then you're going to lose money through what's known as the split gap. That's the way the actual platform itself makes money. In very basic terms, they buy this from me for £10 and they sell this back to you for £12. So if you're buying shares, or we'll say this is a share, if we're buying this share, it costs us £12. But if we're selling this share, we only get £10 back. So that £2 in that hypothetical situation is known as the split gap, and that £2 would be kept by the broker, and that's how they make their money from people like you and me investing on their platforms. So what we never want to do is invest money into something and then look to retrieve that money immediately, or even in a fairly recent timescale. You need to make sure the money you put into investment is money. What you hear a lot of people say is only ever invest money you can afford to lose. Because you may lose it. It's if you invest in the right way, it's very unlikely you're going to lose it, or at least lose it all. If you invest in something like an S&P 500 index fund, you might see a crash. A severely bad crash would maybe take your money down by 20%. And then if you cashed, you could lose that kind of value on that. But that would depend on taking your money out at the wrong time. One thing I would like to say, and I do want to quote the great Warren Buffett here when he says, "Time in the market beats timing the market." What that means is the longer you can just buy a share or a commodity or anything you can, not a future, because that wouldn't count, because they have a sell by date, or a CFD, because CFDs have to, it's basically CFDs day trading. You have to sell that share by the end of the day, or it costs you even more money to own it because of the contract. But as I say, when it comes to investing, you're looking to hold on to these things for as long as possible, or till the right time, which is, if you ever see a spike in the market where it just shoots up, that might be a great time to take some money back out of the investment and maybe reinvest it into other places, or just take that profit back and enjoy it for yourself. And another way that people lose money on investments, this is probably the most uncommon way after the other ways I've just mentioned, but that's just a bad investment. That's just something where the company's promising services, it's just never going to be able to deliver. The price of that stock's going to go down. Maybe the company's just in far too much debt, and they may go bankrupt. If a company goes bankrupt or goes into administration, that's when you can start to lose everything, because if it goes down to zero value, then your investment goes to zero too. So obviously, hindsight is always 2020, but always try and be wary of a bad investment. Personally, I invest in long-standing companies such as Coca-Cola, Johnson's and Johnson's, the kind of companies that I think are going to stay around for a long time. But look to your own lives. What brand have you been using your entire life, and you would never ever use the other brand because that brand is so much better than the others? Now, if you have an experience with a product like that, that's the kind of thing you want to invest into. Because if you have that kind of love for the product, I can guarantee you a lot of other people do, and it's probably going to be something that's going to be worth more money in time. Okay, so with that being the case, I've probably rabbled on for long enough now about all the different types of investments, and I do think that's covered most of the basic information anyway. If I have missed anything out or got anything wrong throughout this video, please do let me know in the comments below. I'd be very interested to know what you all think about what I've said today, and you know, your thoughts on investments. Do you just buy precious metals? Are you like me, where you diversify and you try and have a few different investments? Precious metals to me is just my most recent investment, so this is something I'm looking to build going forwards. I have been investing for around 10 years now, with various degrees of success, but I you know, I am mostly gaining profit. You know, there's been I stay away from cryptos. You'll notice I didn't mention anything about cryptos or any NFTs in the video. It's not something I deal with. Just very quickly before I close off, it's a cryptocurrency. So you're buying a little. It's like buying a dollar and waiting for the dollar to be worth more money, and then you know, changing it back to a pound. But with digital currencies, you'll find that they're a lot more volatile because of the basis of and the nature of them, and you know, where they derive their value from is more in line with popularity rather than necessity or being backed by anything physical, which is one way why people can lose a lot of money now. Back in around 2020, Bitcoin was going very bullish, and was just basically going up and up and up in value. Now, I know a few people who invested in Bitcoin at that time, and they just thought it was a cash cow. They just thought, you know, it was just going to keep going and going and going, and then it crashed and it just plummeted, and people lost a hell of a lot of money, and Matt Damon got a bad reputation. 10 points if you get that reference. But that being said, I think I really have dribbled on enough about investments now for one day, so I'm going to wrap it up there. Before I do so, you may have noticed the box right here. Well, that's because I am still running a giveaway at the moment. Time is running out on the giveaway. If I don't hit 100 subscribers in the next 4 weeks, that's the 31st of March, I will be opening the box and giving away all 3 coins involved. But if you do want to hear more about that, then you're going to have to click that video right there. Okay, thank you very much, and keep stacking. Goodbye.